All right, hello and welcome to episode 2 of the Willow Private Finance podcast, in which we talk about what on earth's going on in the property market, what's going on with lenders right now, all to do with UK property and lending. So with me today, we've got Stephen Pendry again, who was with us last week. He's one of the Willow Private Finance team. And joining us for a change is Rob Holmes, who wasn't able to join us last week, and David, who was with us last week, isn't able to join us this week. So it's us three again today. So Rob, actually, Stephen, as you introduced yourself last week, Rob, do you want to introduce yourself now and just explain a bit of your background, type of things that you tend to be involved in?
Okay, so my name is Rob Holmes. I've been a property investor for 15 years now. All of my portfolio is in the southeast, so around Brighton. Got a mixture of single lets, 1 and 2 bed flats, leasehold, share freehold, small blocks of flats, and HMOs. And I've been kind of using bridging my own projects for a number of years to buy things, turn it from 1 beds into 2, 2 beds into 5 bed HMOs, 3 beds into 6 bed HMOs. So the kind of the buy, refurb, refinance model that a lot of investors are using at the minute is what I do. And then a few years back, I was really fortunate. I was able to kind of leave my career and go full time into property. And about 18 months after taking a break from work and leaving my career, I decided I should probably do something with my life. And, what could I do? And a lot of my network were property investors. I was going to the property networking events as an investor. I was introducing a lot of business to my broker at the time, and then kind of decided, oh, this looks like a bit of fun. I'll give it a go. So I did that, and I kind of specialize and spend most of my time dealing with buy-to-let mortgages, HMOs, and then niching into and specializing in bridging and development, and then things like Airbnb, short-term lets, limited company, all of that sort of stuff.
Cool. Thank you very much. So, gentlemen, we were just starting to have a bit of a debate before we began this podcast about what's going on in the market at the moment. So the last podcast, we were a week after the Bank of England rate increase to 5%. And we were starting to discuss, okay, well, what's the general sentiment out there now? Now we're like 2-3 weeks down the road. And you guys started to have a debate in terms of what you were seeing in lenders. So do you want to share some of that and share some of your thoughts?
Well, Steve started by saying rates are going up today, and I went, hold on a minute, I'm getting emails saying they're coming down. So you've got to figure that one out.
It basically shows the market, right? Like banks are, we had good news. The swap rates have come down a little bit, the rate that governs the rates that the banks charge us as clients to them, and banks don't know which way to go. So yes, there's mixed messages coming from the market at the moment. I've seen two high street banks come out this morning saying they're putting rates up tomorrow morning, and I've also seen one quite specialist buy-to-let lender say that rates are coming down, but Rob seemed quite adamant that he'd only seen rates coming down.
Well, it's early in the day for me, so I haven't looked at my emails yet. So just give me a chance. But yeah, I've seen two emails today. Actually, sorry, one on Friday, one today. Fixed rates. Just having a look at it now. And what it says is on our fixed rate products, including standard properties, HMOs, and multi-unit freehold blocks or MUFBs, have significantly reduced rates by up to 70%, 0.7%. Cool, by 70%, that'd be amazing, wouldn't it? I'd refinance everything I've got. So yeah, I think, as Steve said, they're going up and down and kind of all over the place. And for me as a broker, it's mainly about just investing, reacting to what's happening at the time, and just staying adaptive, really. I mean, I don't know about you, Steve, but the thing that I'm finding most annoying is my workload is, on some cases 2 or 3x what it should be, purely because I'm sometimes having to place these cases 2 or 3 times, because I'll do all of the research and all the work, place the case, make the recommendation, client doesn't come back to me quick enough, or you get a half a day's notice or a day's notice that the rate's changing anyway, and you lose it. Some lenders are not honouring rates after you've got the case in anyway, so there's no guarantee. And and we're the ones that get it in the year. But I find that my workload's kind of increased because of that at the minute.
And it's often the way that we do such specialist lending that there is only one or two banks in the market that will do that deal. It fits one day and then the next day it doesn't. It is a difficult time. I think I'm quite optimistic. If I'm completely honest, I'm optimistic about the market, because this time last year we had 5-year fixed rates at a lower rate than the 2-year fixed rates, which to me signals the bank want you to do a shorter term fixed rate, but now it's the opposite way round. I was looking this morning, and we use software to have a look at the whole of the market. That's why we're worth our weight in gold. We can compare every lender basically by the click of a button. And the lowest rate in the market at the moment was just above 5%, 5.04%, but it was a 10-year fixed. Right now, everyone goes 10-year fixed. Like, I mean, personally, I've never advised someone to do a 10-year fixed. Maybe that's to my detriment. I should have done it 2 years ago when they were sitting at 3.5%. But it signals to me that when 2-year rates are more than 1% more than the longer term fixed rates, then the banks expect rates to start coming down at the end of those 2-year fixed, so that they can charge the public a higher rate for longer. That's me being an optimist, but also being pessimistic about the banking system.
They are money at the end of the day, aren't they? It is a business.
Yeah, and it led me down a bit of a rabbit hole again, because last week's rabbit hole was finding out about statistics of house building, but this week's rabbit hole was what actually governs the swap rates. So for those of you that are listening, and you understand that obviously swap rates govern the rate at which banks can borrow money, my mind was, okay, so why does it govern that? Now, between banks, they lend on the LIBOR rate, which is the interbanking something rate. I don't know the exact, don't know what the acronym stands for, but apparently banks borrow at the LIBOR rate between each other, and then they pass on that lending based on a risk of paying that LIBOR rate. Okay, so if they see the LIBOR rate at 4%, and all the predictions in the economy are that rates are going to rise, then they are going to pass on that lending at a higher margin, because the interest rates might vary all over the place. So that's why that's what swap rates are governed by the risk plus LIBOR, effectively. Okay. So what that says to me is that the economy is in a bit of turmoil. But the great news is that inflation came down a little bit to 7.9%, which has made everyone in the industry take a bit of a breath. And therefore, the risk plus LIBOR goes down a little bit, which is the swap rate. And therefore, the lending comes down a little bit. We won't see it immediately because it's too short term, but I can see rates probably coming down a little bit by the end of the year. But who knows? I mean, I was talking to clients 2 years ago saying we're in the best time ever. I mean, it actually says on a document issued by banks that they have to show you what your payment is going to be if it rises to the average of the last 25 years. And those payments were horrendous. Like, you're looking at 9.6, 9.7% APR. And you say it to the client, you say, that's what could happen. That is the risk of taking a mortgage. Okay, these 5 years are fixed, but after that, I don't control interest rates. But having said that, the amount of people that have mortgages in the UK, rising rates will have a significant effect. And that's why we're seeing inflation coming down already, despite everything that's going on in the economy. But it'd be interesting for me, Rob, because you do a lot more of the bridging side of things. I also do bridging, but I haven't seen that much of a change really in the bridging rates, which represents quite an opportunity for investors, in my opinion, because when you're looking to buy a house to renovate a year ago, 2 years ago, the disparity between bridging rates and buy-to-let rates was horrendous. So people you could see it on the customers' faces, like a bit of a frown, like, really? It's 4 times the rate that I'm going to be paying with a normal bank. But now, I mean, is there a 2% difference?
I mean, bridging rates have gone up a bit, but they haven't gone up as much as the harshness of the increase on things like buy-to-let rates. So for instance, a year ago, I'm going to give you kind of the median range of the market. Obviously there's going to be ones that are cheaper out there, and there's going to be ones that are more expensive. Octopus had a really, really good rate of like 0.55% for bridging. They still have it, but now you're only getting it at like 55% loan to value. But at 70% loan to value, they're still pretty good. Or they were when I spoke to them recently. I believe that was 0.85 or 0.89. But the market standard last year was up to about 0.75. So most of the market would be around about 0.69 to 0.79. We're going to be a little bit below, a little bit above, but you'd find most lenders kind of sitting in that kind of range, or the majority of the ones that I dealt with as a broker or investor anyway. Now, realistically, you're looking, 0.9 to 1.05 is where most of the same lenders are going to be. And the mainstream ones even recently had to raise rates. So I had a development exit deal, really chunky development exit deal, 10 properties. Client needed about 1.6 million to exit some dev funding. The development lender didn't want to extend, as a lot of them kind of don't at the moment, but they weren't ready to sell. And we got that secured at 0.79. Which was like an incredible rate at 75% as well. And even that lender had to raise rates, and it got to the stage that we actually managed to get that deal completed before the client's rate had to be raised. But that rate went from like 0.79 to 0.99. It's a huge difference, which
this is fast becoming a legendary case in Willow, because you did it as an exception.
Yeah, so this is why I was going to jump in, because I think sometimes we can get hooked on, or the outside looking in just thinks of, oh, they just got this rate and then that was it. But the effort and the journey that you went on behalf of the client to ensure that he got what he needed, to me, underscored why people need specialists in this space, because it's not just about, oh, I just found you a rate. The amount of negotiation, you might want to share some of the pains that you had in some of that. Obviously, we have to be careful about how much information you give, but from a broader perspective, the commitment you had on getting that across the line for the client, and the implications had you not, on why specialist support, especially where development's concerned, is so important.
Obviously, you know a fair amount about the case, because obviously we were dealing with it and working on it as a team. So I mean, I think it would be pretty fair and not an understatement to say I traveled to the 7th level of hell and back to save that case. I don't think that's an understatement. But I think a lot of it comes down to knowing what to do, who to talk to. A lot of it's relationships with the lenders. So for instance, I genuinely believe with that particular case and that lender, there was a point that we had to complete by, and all of their cases had to complete by this point, before getting reverted to the higher rate. And we were given an extension, and we were given an extension of a week, and the difference to the client was about 20,000 that they would have had to come up with last minute. Which is a lot of money for anyone. Most people don't just have 20,000 lying around, multiple deals going on at once, etc. So I think a lot of that came down to the strength of the case and the client as well, and that we were showing that we were doing everything that we could. And there was a few issues from other professionals involved. Too much detail, basically not doing things that they should have done in the time frame that they should have been done in, or saying something had been done and 10 or 12 days goes past and then we find out it hadn't been done, which obviously delays. And 10 or 12 days in kind of a bridging or development cases is a lifetime, especially when you're under the gun and on a time limit. But we have got a really good relationship with them, and I think that helped for them to go out of their way with that case, and keep that one going. And then we actually didn't manage to get it done extension, and I have no idea how I managed to do it, but I managed to get them to hold it for the next weekend as well. But I think I might have got down on my knees and begged on behalf of the client, and it worked. So we got it done. At the end of the day, the important thing is it's not always going to go your way, and that could have very easily gone against the client. Unfortunately, not really through any fault of the client or us as the broker, but from another professional that wasted time basically. But it could have been expensive kind of outcome for the client. But you know, I was really happy in the end that we managed to do it. Client's happy. Bought another 12 months on that dev exit for them to get those properties sold, or if they decide not to sell all of them, sit on them for a bit, wait for rates to relax a little bit, we hope, and then we can look to refinance them.
Off that point, Rob, don't you think that this economy is an absolute prime time for investors to make money? From two perspectives, really. The first one is obviously, I mean, not to make money, but to take an opportunity, because the first thing that came to mind was the bridging is going to buy you a year effectively, right? The rate is not too much higher than the buy to let rate. It's going to buy you a year, and hopefully in a year's time, things are going to be in a different shape. So the risk of taking bridging is actually lower. The second thing is, surely, I mean, I'm seeing it definitely, like the offers that I'm telling my clients, because I always have a discussion with the clients when they're going to offer on a house, what they should offer. We're offering 10% below market price and they're getting accepted. So to me, it represents a great time to be a property investor, unless you're coming to the end of a long fixed rate deal. So
funny, there's quite a lot to discuss just from those few sentences, because I can talk to you as a broker and as an investor. So I've actually got a deal at the minute. It's an HMO and my mortgage, I believe, was 3.29%. And I've been in property 15 years, and I would always do 5-year fixeds. It's what I did. And then on that one, I just refixed it for 2 years, and it comes up next month. And I got my Kent Reliance letter through, and it was going from £690 fixed to over £2,000 a month on variable. Obviously, I'm going to refix it, but my product transfer rate is 5.99%. So it's still going to go from 690 to 1200. So in terms of, let's take a step back, and in terms of talking about getting into the market at the moment, let's talk about the people that are already in it. So with HMOs especially, there's a number of things that are hitting landlords, which could put them in a bit of bother, combined with the timing of potentially coming off of fixed rates. So, you know, let's take average HMO, maybe a 5-6 bed HMO. You might make a net profit, pre-tax net profit of £1,000, £1,200 a month after your mortgage costs up until this point, or up until, you know, the last 6 months or a year or so. And there's a few things that have happened in the last 18 months. The first is the VOA, which is the organization that does council tax banding. And traditionally, HMOs are one council tax payment, Whereas what the VOA have been doing is targeting landlords and individually council tax banding per room. Now, unless you're like a student landlord or something like that, if you're a landlord for, say, a working professional single AST, usually the landlord pays all the bills. So that landlord that's paying one council tax bill, that could be 100, 150 pounds a month, could get hit with 5 or 6 individual council tax bills. And all of a sudden, on your £1,000, £1,200 pre-tax net profit, you've just lost £300, £400. Okay, that's the first thing that's happened or has been happening recently. I actually know of an investor. I don't know this person, but I know of this story, and it's locally to where I've got HMOs. And they bought a property, and it was, I believe it was a 7-bed HMO. And 2 years after they bought it, the council then individually council tax banded those rooms. But then on top of that, they backdated it as well to when they bought it, and they got hit with a £20,000 plus council tax bill. So yay, that was really nice for them. So that's
and there's literally nothing you can do about it, Rob, either, is there? Like, it's one of those things you have to mitigate.
Keep your head under the parapet. That's what.
Yeah.
Don't let them find you. So that's one thing that landlords are faced. And then obviously electricity, gas, utility increases, right? So a lot of people have seen that over the last year, 18 months. And so if your gas and electricity has, doubled or tripled in price, and you're running a 5-6-bed HMO, instead of having a couple of £100 as your gas and electricity, is it now going to be £400 or £500? And I've seen my HMO bills go up massively. So that £1,000, £1,200 a month, if you get hit with individual council tax banding, it's going to go down. It's definitely going to have gone down in terms of the electricity and water rates and gas, etc. Okay, and then now on top of that, you've got this perfect storm, as I've just given you an example of just my own deal, where my mortgage rate has almost doubled from 690 to just over 1200 on a fixed, going back into a fixed rate. And so all of a sudden, and I'm a low risk investor, by the way, I will take risk, but it's very calculated, and I like to win. I don't like to lose. So I don't over leverage. Okay, I don't take high loan to values. I don't take too high of a risk. I'm kind of a very, I'll structure things creatively, but I still like my vanilla bread and butter buy-to-lets and HMOs. But you're going to have people that have gone into 85% loan to values. You're going to have had people that have gone into commercial yield-based values or valuations or lending on sui generis 7, 8, 9, 10, 14 bed HMOs. Well, those commercial rates were more expensive than regular buy-to-let rates traditionally anyway. So imagine coming off of one of those fixed rates as to where they are now, combined with individual council tax banding or utility rates. Now, I'm not here to be doom and gloom, okay, at all, because I still believe, where that, the best time to invest in property is always now, and just sit on it, right? But I do think we're going to see quite a few investors who have over leveraged or a little bit cash strapped being in quite a bit of a painful situation when their previous 2 and 5 year rates come to an end, and they get a bit of a shock of a lifetime as to what we can do for them now. So that kind of ties back to what you're saying about offers going in lower and things like that, is that, they're not going to be able to make any money every month. They're just going to be sitting on assets. And that the key thing is, can they ride out the storm, right? So I always look at it as treading water. What's my worst case? If I'm not making money on an asset, how long do I have to tread water? Is it going to be a year, 18 months, 2 years of making next to no profit, but not losing money? But if you're, type person that's got 5, 6, 10, 12 properties, over leveraged, getting underpaid, utilities have gone up. So obviously I'm using HMOs as an example. if you've got rooms empty and you're now paying to hold those assets every month, how long can you tread water before you really get yourself in trouble? And I think that's what we may start to see a little bit of. I hope not, but I've done a lot of property networking and property courses, and a lot of my clients have done property courses as well. And I know what people are being taught, and I know how they're being taught to invest. And, you know, and I can kind of take an educated guess as to the type of pain some people are going to be in. If
You're almost
where there's going to be a lot less profit on my property. And as I said, I took low risks.
You're almost safeguarded by the lender, right? With the stress rate. So, for example, if you're buying a property and you want 75% loan to value at the moment on a 2-year fixed, I don't think it's going to happen. The rental yield is not enough in any property that I've seen recently. Even HMOs are starting to struggle. But I think you're protected by the lender in some respects there, because they're not going to lend money out that you're not going to be able to pay back. Because I think people are still getting to grips with taxation of rent and not being able to take the mortgage payments as a cost unless you buy it through a limited company. But maybe you're referring to personally owned assets where you don't have the similar tax benefits that you have if you bought the asset in a limited company.
I mean, yeah, I understand what you're saying. I meant more people that have already got the properties and they're already in their previous fixed rates from before this absolute bedlam started, and they're now going to start coming off. Those people are the ones that are going to be in trouble. If you're going into the market now, as you said correctly, safeguarded by the lender, that if it doesn't stack up, they won't give you the money to buy the deal anyway. And if it doesn't stack up, if you know how to invest in property and how to calculate ROI and set your targets and all of that sort of stuff as to what you want, then I can give you a prime example of that. There was a house actually locally to me that I went to look at. Most houses like that go for about 295. Perfect house to change from a 3-bed property into a 5-bed HMO. Probably cost 30 grand to do it. And I was picking those up, a few years ago I got a couple for around 190. I got one about 18 months ago for 230. So at 265, I would do that deal now, if the rates were what they were a year ago. But because of what the rates are now, even though that is still a good deal now, it's not a good deal anymore, just purely because of the rates. There's not enough money in it. So
what would you do as a landlord now?
With regards to that deal, what would I do?
With regards to the market the way it is, are you going to be increasing the value of the property by making improvements to get?
Well,
are you going to sell the property?
Example, so for that deal in particular, I wouldn't have even paid that amount of money for it, even though it was a good price, because it then didn't stack up on the back end with lending and returns on investment. So I would either just not do the deal, or I would go in with a much lower offer. And I think that's what you're going to find investors having to do to make the deal stack up. All right. But for me as an investor, I buy properties that need work doing to them anyway, and then force appreciation through doing a refurb. So I'll buy on a bridge, do a refurb, then refinance to a buy-to-let lender or sell. And for most of the time that I've been investing in property, I've bought and held. So I've sold one property that wasn't a refurb. It was very early on in my investing career. Bought it, sat on it for a few years as an investment. It was a new build, and then I sold it. But other than that one, I've only done one flip where I purposely went into it to buy it, do it up and sell it. Okay. And that was with a joint venture partner. But our discussions now, instead of buying to hold, our discussions are, at the minute, we're going in to buy to flip, unless we can recycle most of our money out, which at the minute we're not finding the deals down in the southeast where I can do that, or where we can do that. So for instance, at the minute we're doing a flip in Nottingham. We've done that on bridging. That's with a lender that I've worked with loads myself and with clients. So we'll sell that, and then that money will go into the next flip. And in our head, we're thinking, well, our strategy at the minute is more find deals that we can add value to, because we looked at the end value, we looked at the mortgage rates as they are and the rental income, and it doesn't stack up. We've either got to leave too much money in the deal, or if we get as much of our money out as we can, we're going to make 67p a month in profit and have 60 odd grand tied up. There's it's like 1,000 years to get your money back. So that's why we're saying, so we're going to build a cash pot. So in my head, my thoughts on investing, or my strategy for investing at the minute, have very much shifted from 15 years of buy, refurb, refinance and hold into buy to flip and just build little chunks of cash ready to get in on good deals when they present themselves. But that's just my opinion, and that's relative to the Southeast. I can't really comment on the Midlands or up north, etc.
It's an interesting point, because it comes back to the development exit you did, right? We haven't addressed the people that are coming off of bridging when rates were potentially very low and the exit was easy. The exit was very easy. Now we're seeing landlords that have bought with bridging or done a development with bridging, and there's no one that will give them enough money to exit off of that bridge, which is a very bad situation to be in. Luckily, we have options in that we have development exits, we have imaginative lenders. I mean, I did a purchase, but yeah, I did a purchase today at 5.51% limited company buy to let, and it worked because the mortgage was relatively small, but the banks have got imaginative by saying, okay, we can charge a lower rate, but we're going to charge a 4% fee. On a larger mortgage, just doesn't work. But yeah, it's a difficult time for all. But as I said, I'm optimistic.
When that
in 6 months,
when that first started happening, where rates peaked, and then nothing stacked, and then all of a sudden there was a lender that came out with a rate. I forgive me, I can't remember exactly what the rates were, but it was much lower rate in the market. All of a sudden, everything was stacking, but it came with like a 5% arrangement fee. And well, you know who I'm talking about. But
yeah,
I sent my
still doing it now. Yeah,
I sent my BDM a message. Bless her, I really liked her at the time. And I said, "Is this a joke? 5% arrangement fee? Are you taking the?" And then there was lots of words that I've been told today I'm not allowed to say, so I'm going to tone it down. And it was in jest, but I couldn't believe it. I was like, "You can't do this to clients," and da 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 da. And then, it's like when people used to use that phrase, "Oh, this is the new norm." Well, this is the new norm for lending now. Is if you want to get those lower rates to make the stress testing fit, you're going to get bent over a little bit on the arrangement fee. And people are getting used to it now. I mean, I've still got clients that have come back to me who have been on all of these fixed rates, and they haven't had means to look at it. They can hear noise in the background, but until you look at it for your own deals, you don't realize, and you go, oh, bloody hell, that's a little bit painful. But yeah, I've got back on your point about what people were getting and what's here now. Is I sent terms out the other day. Actually, I've got someone that came to me for another development exit, and it's a semi-commercial, so it's a commercial unit with flats above, and it's in London. Great property, great deal, great value, and they had an incredible rate with a lender, right, that they had organised previously. So I didn't do the original lending, and I mean, you're talking with a rate that starts 0.5, right? And their dev exit lending, their development lending is coming to an end, and they've already had an extension with that lender. So they now need 75% gross loan to value, of which most lenders are not going to hit that because it's semi-commercial. So I found a couple of lenders that would do it. I even managed to negotiate a lender that I like working with, that would normally only go to 70%. They agreed to go to 75, and gave the rate. And the person hasn't come back to me. But I know they haven't come back to me because they couldn't believe how expensive it is now to what the rate is that they got for themselves, 18 months ago. And I think it does take people time to come to terms with where we were and where we are now. But the problem with doing that is the longer that person holds on to this old rate and that hope of trying to find something, the less chance I have of getting them out of what they're in now in time. And, you know, because it doesn't just happen overnight, right? So once you say go, I'll start running 1,000,000 miles an hour, but not before then. So, you know, if their extended development funding runs out, all of a sudden we're into penalty rates, penalty fees, etc. And all of the money that I got them, which is what they needed, very quickly starts to get chunked down and eaten into time-wise. So, you know, all I can do is follow up and say, look, are you ready? Do you have any questions, etc. But ultimately, what's really, really important is people get over what rates used to be and get on with what they are now. And I think, you know, don't waste time, especially if you are talking about bridging or developments, etc. Yeah, there's going to be a slightly cheaper rate here or there, but they're all there or thereabouts. And sometimes it's more about who can get it done quickest, or who's not going to make you jump through the hoops, or is it auction conditions, is it not, etc. So I think that's an important point as well, is really, really think about, look, this is where we are now, and we've got to kind of make the best of where we are at the minute.
So you guys started to look at this or started to discuss this earlier, but I think it's important that we circle back around. So obviously you guys are the brokers, and we've got a good chunk of our client base sit in either development or landlord space. And Stephen, you were alluding to this earlier about, well, what do landlords do? What do all of these people do? And how can we give them some reassurances? Because it sounds or some easy steps to take. Because I would imagine there's a lot of people in a lot of fear at the moment. They're going to the media, they're going to all of these places, and they don't know which way's up. So what would you recommend, guys, in terms of trying to give them some kind of peace of mind?
Stop watching the news for a start. My life became so much happier when I stopped watching the news. There's going to be a lot of fear mongering out there. So that's why I said earlier when I was talking, I'm not trying to be negative. I'm just trying to give a balanced viewpoint, balanced opinion of what I'm seeing, what I'm experiencing, okay, and my opinion on what I'm doing for me. So it's very important that you look at what your risk appetite is, how long you can tread water. You know, is it your only source of income? If so, where is it going to be? So, you know, I've got spreadsheets where I've looked at my portfolio as it falls off fixed rates to where they are now. So I can see what my profit was, and I can see what it's going to be, right? Or I can estimate what it's going to be. Okay, it's not the prettiest thing in the world, but I'm planning ahead. Okay, as well as that, if you're in the Southeast, and again, you know, I can only talk about the Southeast because that's where I am. I'm seeing rental rates rise a lot. So, for instance, I've got a 2-bed flat that's, for the past year, it's been rented at £900 a month, and I'm not one of those people that is always trying to force the rent up. I don't need to do that. But when I look on the market now on Rightmove, and I talk to local estate agents that I've got good relationships with, they're all saying that's a £1,200 or £1,300 a month flat now. That's an insane increase. I've got 2 flats in the same building, and I've got 1 flat that I rented out in January or February at £725 a month, and these 2 flats are actually next door to each other on the same floor. So £725 a month. Trying to sell another one, and it's not sold at the minute. And so we're considering, right, do we just refix? Because we're on a standard variable rate. That was one of those ones we put on a 2-year rate, and we'll take some more money in 2 years. And it fell off of its standard variable in October last year, just as the rates went mad. And we couldn't refix with the current lender because the limited company structure, they got bought out by someone, and they don't do layered limited companies with 2 limited companies, etc. So we were like, oh, we'll wait it out. And then we decided to sell it because we want those chunks of cash to go in and do flips, and we haven't sold it. So there's all of these things that are happening, and so we're now considering, right, are we going to rent it out? So considering flat 1 is getting 725 January, February time, I rented that. The agents just come back to me and said, Rob, you might want to think about dropping the asking price, or we can rent it. We'll get you 875 a month. Again, 1-bed flat, ridiculous increase. I've got a garden flat with parking. It's rented at 800 a month. Garden flats with parking in this town are going for 950 now. So in terms of what landlords can do, I would definitely suggest talking to your estate agent. You know, there's an old saying, it's better to have a happy tenant that is paying the rent. If you're not careful and you try and put the rent up too much and then they don't pay, you're going to be in a bit of a worse situation. But talk to your agents, because, you know, I'm seeing here that rents are increasing, and this is the thing, that whatever happens to rates, whatever the government do, etc., all landlords are going to do, because they have to, is it's always going to get passed on to the tenant, unless you are very philosophical, you know, philanthropic investor with mortgage-free properties, and you can help people out. You know, when you're mortgaged at 75, 80, 85% and rates are going up, rents have to go up to cover the cost. So I think that's what you're going to find landlords are going to be doing as well, raising rents on rooms to cover kind of increased utility costs, raising rents on everything else to cover mortgage costs.
My input there is that, firstly, Rob, you need to speak to a good mortgage broker, so I'm always available. Secondly, well, there's a few things.
Sorry to interrupt, but at some point I'm probably gonna have to talk to you about my protection, because I need to renew it all, because, you know, I've bought and sold things, and so yeah, we should have a chat about that.
Yeah, that's a whole other conversation. That is protection for landlords. Nobody even thinks about that.
You know what prompted me to put that on my to-do list, that I need to get you to talk to you about that, is I didn't realize what you told me the other day was that, obviously, so I as a broker deal with a lot of clients who are investors. Okay, so less on the resi side and the protection side. 99.9% of my cases are going to be bridging, buy-to-let, HMO, development, and then probably 80% of those are going to now be within a limited company because of the tax laws. That's what people are doing. And you said to me the other day, which I had never considered, and no one had ever taught me either, is that if you do a director's loan to your limited company, which is what I've done, and which is what most investors like me are going to do, you open a limited company, well, you need a deposit, so you're going to put money in as a director's loan to go start buying property. Well, if you die, it's immediately repayable, right? Right.
On death, yep, immediately into your estate. Yeah.
So I should probably get that sorted in having something in place that will cover that. But, you know, there's going to be clients out there that have done 100, 150, 200, 500,000 directors loans into their company. That's then, it's not sat there anymore because it's gone into deposits. It's now tied up. It's illiquid. They're not going to be able to get it out unless they sell on death. But the problem is that the whole point a lot of people do this is A, to create cash flow, but B, to create a legacy. So what's the point in building a portfolio to die and they've got to sell it all because you can't pay your director's loan? So that was a really cool point. So I know that went off on a bit of a tangent.
But even if you don't have lending, it's an issue. It's even more so if you don't have any lending. If you buy a £500,000 property in a limited company, like a block of flats, for example, in Liverpool or somewhere, and you put £500,000 in to buy that property, that £500,000 needs to be paid out one way or another if you die, which it's a big thing. But going back to,
sorry, I'm just going to point this out to anybody that's listening, which Willow Private Finance can help with. Just to be clear,
can you imagine,
don't just do mortgages.
Can you imagine if we just had this whole conversation about that, and then people are like, yeah, I should really do that. I'm gonna
exactly. They go off and find someone else.
It's something we often forget, right? We know exactly what we need to do and how to do it, but we'll never oversell ourselves, which is probably to our detriment. But I think that the two things that landlords need to remember is, first of all, I mean, apart from the one that Rob brought up, most of the time, if you haven't missed a payment on your mortgage, most lenders will give you a new rate, regardless of, you won't be stress tested again. So don't get too worried about coming to the end of a fixed rate and seeing the variable rate. Most lenders will always offer you a new rate at lower than that variable rate anyway. And the second thing is, I would always speak to professionals. Okay, so yes, we're selling ourselves, we're mortgage brokers, we can get you the best rate in the market appropriate to you, but have a chat to an accountant. If you've paid 300 quid to your accountant and you're a portfolio landlord, it's more than likely they are not specialists in property. Okay, go and spend the money on a very good accountant that is going to know all the ins and outs and how you can reduce your tax bill, if there is a way of doing it. So like Rob said, the margins are very small now. A good accountant can double or triple your margins based on what you tell them. And we have connections throughout the industry. I mean, I would say 50% of, no more than that, 75% of landlords that come to me that have used a previous broker or they've done it themselves have not had structured tax advice. So it's always the very first question that I ask. Have you ever had, or do you plan to get structured tax advice? What do you mean by that, and how do I get it? Okay, I can refer you to someone that I know that I've already worked with for 5-10 years, which is a good thing in that you can trust who you're referred to, right? I'd say 20% of landlords have a will. Another thing that you guys need to consider, okay, because it's not a 1 in a million chance that you're going to die while you own a property.
Mm.
We had a conversation with a provider the other day, and for a 34-year-old non-smoker, you've got a higher than 50% chance of either dying or become critically ill or not being able to work for more than 2 months in the next 25 years, which to me is insane. I'm 34 years old.
You know what? Another big one is power of attorney as well.
Yeah, powers of attorney. Yeah.
I was at a property networking event a few years ago now, maybe 3 or 4 years ago, and the guest speaker was specialized in wills and powers of attorney, and it was a brilliant presentation, but on the power of attorney side of things, I have never so suitably had the living shit scared out of me in 20 minutes as during that presentation. The things that happen, even if you're a married couple, the things that will happen if you end up in a coma or incapacitated, etc., to make the other person's life a living hell are ridiculous. Bank accounts being frozen, where you get treatment, things like that. And you know, I was sat there and I immediately sorted my powers of attorney out immediately, and I was, about 30. So I've now got 2 powers of attorney in place. I've got powers of attorney for health and wellness, and then for finance, and that doesn't necessarily have to be the same person. But if you are a property investor, well, to be honest, anyone should have it in place. If you're married, with or without children, got property, etc. But as a property investor, powers of attorney, really, really important, because you don't want to get hit by a bus, wake up a year later, and your entire portfolio is gone because, someone else took over that you didn't want taken over, and things like that. So look into those. Definitely.
Indeed. I wanted to finish up, so it's completely off track, but it's something I became aware of this week with regards to residential mortgages. I wonder if anyone can explain this to me. I know that it's a help for the public, but the Bank of England have said to banks, you need to help people with the increasing cost of mortgages. And I've seen 3 banks this week say that if you're an existing customer with that bank for your mortgage, you can switch to interest only for 6 months. Okay, so that's a great way of saving some money for anyone that has a residential mortgage. The bit that I don't understand is that we've got this rate situation because we're trying to control inflation, and therefore, well, I mean, before that we're trying to control people's spending, but banks have been told they have to help you reduce mortgage payments. So for me, that's my rabbit hole for next week, is to go and delve into why the banks have gone in that direction. But it's just something for you guys to know. Ring your bank direct or come to us and we can tell you what to say to your bank and hopefully save some money.
That you're talking about, isn't it?
That's it, exactly. Mortgage
So
charter.
if you are listening, Google mortgage charter, and that will give you a rundown and explanation of that. But it's only eligible for certain people, right? I think I'm right in saying.
Yeah, exactly.
I think I'm right in saying, if you've got other properties or you're a landlord or something, it doesn't apply to you. Because I looked it up. I switched to interest only. Yes, please, more money in my pocket every month. No. Yeah. Cool. Is that us done, Lee?
Good, I think it is. Sorry, I was on mute for that last bit because what I didn't tell anybody is I have a puppy in this room and he's been going nuts while you gentlemen have been talking. So apologies. Yeah, that's the end of the podcast. Thank you very much, gentlemen. Really good. And catch you in 2 weeks' time.
Cheers. Bye.